In this video, we'll break down a tool that helps forecast a price reversal after a sharp, impulsive move. We'll look at specific areas on the chart that tend to attract price. This topic is about imbalance, the price magnet. We'll cover how it forms, how to apply it, the main mistakes traders make when identifying it, and the methods of using it correctly. Imbalance and liquidity are two core elements of the smart money approach, and without them, proper chart analysis is impossible. Before we get deeper into the topic of imbalance, I want to remind you that on my Telegram channel, I constantly share my trading thoughts. There you'll find many smart money signals and educational lessons on the strategy. Imbalance is a three-candle structure where there is a clear lack of balance between buyers and sellers. It's highlighted as a zone or a gap between the extremes of the first and third candles. Here, in the first two examples, we see a bearish imbalance. The color of the first and third candles does not matter at all. The direction of the imbalance is always determined by the second candle. The second candle usually has a long body, and the width of the imbalance depends only on the extreme prices of the first and third candles. In the third and fourth examples, we see a bullish imbalance. We mark it the same way, by using the extreme points of the first and third candles. Across different sources, you may see various terms on charts, FWG. It's important to understand these all describe the same concept and carry the same meaning. Imbalance usually forms for one of several reasons. The first reason is news releases, inflation data, unemployment numbers, interest rate announcements, NFP reports, and other major events. These can cause sharp price movements and therefore create imbalances. Let's look at this example on the EUR-USD pair. The US released the NFP report, the change in unemployment levels. That's what caused the gap to appear. This is why you should never blindly trade an imbalance fill. Some imbalances may never get filled at all. Always use imbalance together with other smart money tools. The second reason for imbalance formation is liquidity grabs. After the market sweeps a large cluster of trader stop losses, price often reverses sharply, creating an imbalance. In the left chart, we see liquidity pools that have been taken out. Then, analyzing structure, we see a change of character and a bullish imbalance forming. We plan an entry at the 0.5 level, meaning halfway through the imbalance. We see that the imbalance eventually gets fully filled and price continues in our direction. The next reason lies in a large position placed by a major market participant and the reaction of price to a strong support or resistance zone. This zone may be an order block or another smart money tool. After price reacted to a zone of interest on the GBP/CAD pair on the H2 time frame, it created another imbalance. Price then moved in the direction of the signal. The current risk-to-reward ratio is 1:4. Make sure to subscribe to the Telegram channel so you don't miss profitable signals. The link is in the description. So, why does price try to return to the imbalance zone? This range is also called inefficient pricing because there is an imbalance between buyers and sellers. In a bullish imbalance, there were no sellers. In a bearish imbalance, there were no buyers. Since buyers couldn't offer liquidity in that area, the market seeks to rebalance price. This is why sooner or later, the market tends to return to that area, giving both buyers and sellers equal opportunity to participate. In the third illustration, we see efficient pricing. Here you can't mark an imbalance because the extremes of the first and third candles overlap. That means price was offered evenly to both sides. If we look at horizontal volume, we see that our target candle lacks strong volume. This is why the market attempts to return to that area to balance supply and demand among participants. Now let's move to a real chart and see how price fills an imbalance zone over time. From the very top, we identify our three-candle pattern. We mark the range from the first candle's open to the third candle's open. Price eventually aims to fill this imbalance, which it does. Then, as price continues to fall, we mark the next imbalance from the first candle to the third candle. We see a complete fill. Another drop occurs, creating a third imbalance. Price fills only slightly more than half of it. Then price falls again, forming a new imbalance above. It gets filled, then another bearish imbalance appears, and it gets completely filled as well. Later, price remembers the earlier imbalance that wasn't fully filled. After a strong decline, it creates a new imbalance and then completes the fill. Let's look at which zones price usually reacts to inside an imbalance. Again, you must analyze the overall picture and avoid trading imbalance separately from market structure and other smart money tools. The most common reference levels are the 0.5 zone and the full fill, the complete fill of the imbalance. Most often, the entry point is the 0.5 zone, meaning the midpoint of the imbalance. I usually mark the midpoint by eye, but for comfort you can use Fibonacci tools. Along with imbalance, traders commonly use order blocks, breakers, and mitigation blocks. In these situations, imbalance acts as an additional filter and increases the probability of a successful trade. All these trading elements were explained in previous videos. Be sure to subscribe and turn on notifications so you don't miss upcoming videos. We will discuss liquidity in one of the next episodes. Let's now talk about alternative ways to mark imbalance and review several examples. In the first example, we label the imbalance as usual, using the three-candle structure from the extreme of the first candle to the extreme of the third. In the second example, there are two intermediate candles between the first and the last, and the candles between the second and third have no wicks or very small ones. Therefore, in this case, the imbalance can be marked from the extreme of the first candle to the extreme of the fourth candle. In the last example, we again have a four-candle structure, but between the second and third candles we do have wicks. For that reason, we identify two imbalances, one from the extremes of the first and third candles, and one from the extremes of the second and fourth candles. Now let's move to a real chart. Here's an example with a four-candle combination. We marked the imbalance across two candles because there were no wicks. Since we trade based on structure, we notice a bounce after the full fill. In the second example, we again see a four-candle formation. Price returns to the gap only after a long period of time. And as we can see, sometimes there may be no reaction to the imbalance at all. That's why imbalance should always be used together with other tools. Here's another example where we mark two imbalances in sequence. As shown, price reacts to both. Have you ever noticed that imbalance zones can differ significantly across time frames? An imbalance visible on the H4 time frame will not necessarily be an imbalance on H1. This is why sometimes price doesn't reach your entry level, because your zone is not the true boundary of the imbalance. A closer look on a lower time frame usually reveals the accurate range. Always refine your zone of interest on smaller time frames. Let's review a few examples. On AUD/USD H4, we see an uptrend and want to enter on a fill of the imbalance. We place a long position, but price moves away without us. Why did this happen? Switching to H1, we see the imbalance is actually smaller. Because we didn't refine it, we missed a good opportunity. Same asset, H4 time frame. We again plan to trade a full imbalance fill, but price does not fill it. On H1, we see the boundaries barely change. On M15, the same. Price fills the majority of it and then reverses. This is a great example showing that refining imbalance may still preserve its structure. Where else do traders make mistakes when identifying imbalance? The answer is in the inside bar. This price action pattern is characterized by the right candle being fully inside the range of the left candle. If you see an imbalance within an inside bar, the correct way to mark the imbalance is by using the extremes of the larger candle. This is one of the most common mistakes beginners make. It's the reason price often doesn't reach your entry. Let's look at a real chart again. Here's a typical mistake in marking imbalance. Traders mark it as a usual three-candle combination. But what's wrong here? The issue is that inside the range of this large bearish candle, there are three bars. This is an inside bar scenario. Therefore, by our rules, the imbalance must be marked using the larger candle's extremes. Watching how price develops, we see a full fill afterward. Before that, price creates liquidity in the form of equal lows, and then reverses. Always consider inside bars, or you will simply miss your trade. Imbalance can serve as an independent entry point. Using smaller time frames, like M1 or M5, You can attempt to enter on a partial fill of the imbalance, usually at 0.5. Place your stop loss just beyond the nearest wick. Some traders even scalp using this method. But again, without considering structure and other smart money tools, this approach will lead to frequent stop losses. Often, price reacts not to the full fill, but only to part of the imbalance. Let's look at a minute chart example. We see an impulsive move and identify an imbalance. We plan an aggressive entry at a full fill. But let's look deeper. At the bottom, we notice a liquidity sweep with equal lows. Then, the chart shows a change of character. Right before the imbalance, there is an order block. Now we have multiple factors confirming the trade. We enter on the full imbalance fill and the bounce from the order block. Then, we follow the trade as it develops. For a proper entry, a liquidity sweep is required. Let's analyze a strong setup. Several smart money conditions align. First, a liquidity grab, often a significant high on the chart, such as a daily, weekly, or monthly high. Second, a change of market sentiment, visible through structure and zigzag patterns that break previous levels. Third, the imbalance itself. When all conditions align and price returns to the imbalance, we can enter on the reversal. Compare the two charts. The difference is only an extra bounce off a significant high as price approaches resistance. In the second chart, this bounce is absent. Let's move to a real chart, the GBP/CAD pair on H4. We see a liquidity sweep from a previous high, followed by the formation of an imbalance. Switching to a lower time frame, we refine the imbalance, which appears slightly smaller. We also notice a change of character, a shift in market sentiment. Only after this does price return to the imbalance, allowing a potential sell entry. For a bullish setup, the pattern works in reverse. At the bottom, liquidity is swept. This could be a daily, weekly, or monthly low. Then, the market sentiment shifts, and upon returning to the imbalance zone, we enter on the reversal. Here's a real example on USD/JPY 1-hour chart. We see liquidity at the bottom, swept via a false breakout. On the same time frame, we mark the imbalance. To optimize entry, we move to a smaller time frame, M5. Using zigzags, we identify the change in market sentiment. At the bottom, we also notice a mitigation block overlapping the imbalance. Watching price reaction, we see it respects the mitigation block and fills the imbalance. On M1, we observe another CHOCH and market sentiment change, allowing an entry from the order block with high trade potential. We enter and follow the trade to completion. As shown in this video and previous ones, imbalance is most effective when used with other smart money tools. Specifically, imbalance can filter trades or increase entry success. If it occurs before an order block, breaker, or mitigation block, the probability of the trade working increases significantly. Previous videos cover this in detail. Let's review each type of entry. Consider a scenario with two order blocks in a downtrend. Beneath the distant order block, we see an imbalance marked in yellow. After the market structure updates, there is a small reaction to the first order block. But only after the imbalance is fully filled and the price touches the second order block does the market reverse decisively downward. Now, let's look at the GBP/USD pair, where a breaker block and imbalance act as continuation patterns. Price breaks the equal lows and returns, breaking the last structural high and forming a change of character. After the pullback, price impulsively updates the high via a break of structure. This confirms a trend reversal locally to the upside. Next, we see trend liquidity on the left and an impulsively broken order block that became a breaker. When price returns to the breaker, it must fill the imbalance. This creates a strong setup for a buy entry. We place our long, stop behind the breaker, and target the fill of trend liquidity. Then we follow the trade as it develops. Let's analyze the mitigation block and imbalance combination. On the left, we see a liquidity sweep in the form of swing lows and equal lows. At the top, trend liquidity is visible. Price cannot break the bottom low and instead impulsively moves upward. At this point, a mitigation block and imbalance are present. We mark them and expect price to bounce from the mitigation block and likely fill the imbalance. price moves upward as expected, clearing the trend liquidity. Another way to use imbalance is as a take-profit target. Many traders believe that all gaps should eventually be filled. Since imbalance is, in a sense, a type of gap, some traders apply this principle to it. However, before placing trades based solely on filling an imbalance, remember that gaps may remain unfilled for extended periods, days, weeks, months, or even years. Similarly, an imbalance may fill partially, fully, or not at all. This is normal. You must think carefully before trading purely on imbalance fills. Returning to our Euro-US dollar example on the 1-hour chart, we see that the imbalance was fully filled only after 1.5 months. If you had blindly placed trades expecting an immediate fill, you could have taken multiple stop losses. This demonstrates that trading purely based on imbalance fills is a risky approach. Finally, if this video helped you, please like, subscribe, and hit the notification bell. This supports the channel's growth. Any questions are welcome in the comments. Don't forget to check out my Telegram channel for additional signals and educational content.